Good morning, everyone, and welcome to the Sirius Report. My name is Ken Shorten, and I'm here with London Paul. And Paul, it was about spring of 2022, coming out of COVID, and miraculously, 1 million jobs were seasonally adjusted in the BLS report. And now, 2 years later, all those have been taken away. Anyway, Paul, thanks for being a part of this conversation. And
And
it's pretty
likewise,
fascinating as the illusion is quickly being taken away from, or the veil of illusion is being taken away from people's eyes.
yeah, it's a point I've made for years. I mean, for me, it really started way back. I mean, when obviously the illusion of QE zero interest rate policy, what it would ultimately do for the real economy was going to come to pass. As I've said many times before, I contacted governments in the West and explained why this was a disastrous policy, which it ultimately is proving to be. And I think for a time people thought, well, the illusion, if it indeed is an illusion, because people will question it if it can survive as long as it has, maybe it's not as illusionary as we imagine. But of course, the pandemic hit. We then ended up, because they had to print endless amounts of money, with inflation, which somehow not nobody, but nobody inside the Fed or anywhere else seemed to understand that if you print lots of money, it causes inflation. There was all this denial, and then they had to admit inflation was there. And then they made this policy decision on the back of this inflation to say, well, now we're going to have to raise interest rates. Now, for me, this was nothing to do with combating inflation, because in reality, it was always to do with trying to defend the dollar, because gradually over a number of years, this goes back starting in 2014 with the Russians, the Chinese announcing the Power of Siberia 1 gas pipeline deal, all to be transacted in non-dollar terms, was the beginning of de-dollarization. And it has reached the point where the US said, well, if we hike interest rates, it's going to strengthen the dollar. And in strengthening the dollar, will cripple the emerging market economies, will destroy their currency, and they'll come begging to us for dollars. And that way, the world will be dependent on dollars because we force them to be dependent on dollars. Of course, that's not worked out how they anticipated in any way, shape, or form. And the sort of byproduct of this, we've said it before, but it's worth just briefly mentioning it. For example, that by hiking interest rates, gold in dollar terms should have been about 1,200 and not a recent record high of 2,500 as one example. And I'm not a big fan of the dollar index. Whether the dollar index is at 150 or at 75, I'm not interested. But it's something people like to use as a figure of merit. Well, considering how much they've hiked interest rates to over 5%, the dollar index has not performed well. And currently it's just over 100. Okay, I'm only mentioning it because it is something that people do make reference to. I'm only making reference to it to illustrate a point that the idea of this dollar strength in hiking interest rate has not materialized. The fact that in dollar terms, gold is at a record high proves there is no confidence in the dollar, because despite everything trying to smash the price in dollar terms, it has failed to materialize. And that okays as much of the fact that there has been enormous demand in gold, particularly in the East, and that's what's driven the price. But coming back to your initial statement, Ken, and we've made this point so many times in the past about fake, massaged, illusionary economic financial data. And then we have the jobs data, which had been over-egged over a course of a 12-month period from, April 23 to March 24, was it, if I'm right, by a total of 818,000 jobs. So over 750,000. That's a provisional figure. Now, does that mean it could be higher? Possibly. maybe. I mean, I don't want to say it is definitively, but what this demonstrates once again is, how is that data so inaccurate in the first place? I mean, people can't help but look at this and go, is this political? And I know you've got a feeling on this, because my perspective on this is, well, if it is political, it's a bit of a funny time in August to make this announcement if they've spent a lot of time trying to be political and support the Democrats, because this is the big kick in the teeth for the Democrats in revising the job figures to that extent. So obviously, get your initial thoughts on that, Ken.
Well, if you think about it, coming out of COVID, the economy was pretty desolate. Biden was in there. He was being castigated for what he was going to do. And all of a sudden we have this, and they were all seasonally adjustments, 1 million jobs. But that was just the beginning, because they've been announcing the jobs numbers every single month, at least for the last 12 months that you pointed out, but likely even more. And we know this because every single following month, the previous month gets revised down. So when you said, it's got to be more than 818,000, well, it is, because you've got 12 months of revisions lower. So add those onto the 818 and you're talking, well over 2 to 3 million. Now, why would they do it now? Why would they before? Well, the economy's in recession. That is coming up, and even the business analysts and the propagandists in the business world are pretty much saying that it's not a soft landing. The Fed's going to have to do something. Wall Street's been calling for rate cuts going back to their forecasts of fall of last year. They said, oh, first there's going to be 8 of them in 2024. Then there's going to be 5, then 3, then 2. Then they were wondering if there's going to be any rate cuts. And things just started subsequently getting worse and worse. You had the commercial real estate collapse. You have housing, which now is you want to say stagnant, because prices are still high, but people aren't buying because of the high interest rates. So what do you need when you're getting a recession? That's going to be pinned on Kamala Harris going into the election. Well, you suddenly bring in, you force the Fed into rate cuts, because Powell has been talking, no matter how much economic data, whether it's manufacturing, PPI, CPI, all these things that are, 50 or more different data points besides unemployment and jobs, have been screaming recession for a while. But he keeps harping on that one point, the unemployment rate. Well, we suddenly got above 4%. Now we get this big revision that's going to probably push it towards 4.5%, if not higher. Now he has the fuel and the ammunition to say, okay, I can't sit on that data dependency point of jobs and unemployment. I no longer can hide behind it. So they come out of Jackson Hole, and now they're saying that they're going to change policy, and rate cuts now are on the table. Not just on the table, but the expectations are, obviously, we see from the markets today, it's going to happen in September. So by boosting up the stock market, they're going to, I think, politically, they're going to ignore the unemployment rate. They're going to ignore the recessionary climate. They're going to sit there and go, look at the stock markets, they're all-time highs, look at the stock markets. And that's what they're going to push. And many people think that, are erroneously think that the equity markets are the economy. And so they're going to rely on people's ignorance to do that. That's my thoughts on it.
Yeah, and that logically makes complete sense, without any shadow of a doubt. It's going to be interesting, of course, in the process of lowering interest rates, what that does to gold, and by extension silver, what that does to the bond markets. But yeah, generally the average person, whether it's in the United States or whether it's in the UK, the Netherlands, wherever, will just go, well, what's going on with the unemployment rate? They're not going to be interested. Oh, look, the stock, because everyone goes, oh, look, the stock market's an all-time high. So who cares what's really going on in reality? But for me, as much as anything, this is the point where it's always been this balance between defending the dollar at any cost and being prepared to accept there will be consequences for the economy in the process. Now, a lot of the data out there supports the view, and I'm with you completely on this, Ken. And not just the US, I want to talk about parts of Europe shortly, and by extension, the UK. The economy's in recession. There are serious indicators about bankruptcy rates. There's certainly huge problems in commercial real estate, in retail real estate. There is problems in credit markets. And so there is a lot of evidence to support the fact the economy and the financial system's under strain. So the question then becomes, even though we want to defend the dollar at all costs, can we just keep doing this to where we risk destroying the economy in the process? Now, of course, I've always made the point that hiking interest rates to over 5% should have long since blown up the interest rate swaps market. So why hasn't it? So what's been going on to prevent that? And so there comes a point where you have to go, well, there's too many variables in the equation, economically and financially, to continue with this. So in essence, if they start having to cut interest rates, and this is much or be to do with the fact they can't really tighten anymore, so they're going to have to start QE again. Well, you don't want QE with interest rates at 5%. So there's naturally a desire to start slashing interest rates if you're going to go back to QE. And in essence, that's an admission or experiment to try and defend that dollars failed. And we can't continue to do this because it's not working anyway. And in the process, we're risking causing huge problems in the economy and by extension, the financial system. And I think we've reached that point. And there was always going to come a point, we did say potentially really by September time, QT would be something that would have to be considered to be a thing of the past. Whether in reality QT has actually been going on is an entirely different matter. I think that's questionable. But officially, then it's going to be back to QE, and QE forever and a day, because there's ultimately that's the only answer to all this. When everything blows up, they'll have to go to QE to infinity without irrefutably. So at some point, it's going to happen, whether it's sooner rather than later, and that remains to be seen. But it looks like there's just an acceptance that that's where we're at. And as I say, there's all this data that supports the fact that trying to keep interest rates as high as they are is completely unsustainable. And, you know, they can only hide economic reality for so long, because you can pretend unemployment by rigging data and reclassifying people as not being unemployed when they are. But if there's millions more people unemployed in reality, if there are businesses going to the wall, businesses can't raise new finance, people, and certainly we know from US data that, you know, we had all this myth during the pandemic because people got these, you know, stimulus checks, so to speak, for piffling amounts of money that for me had long since been spent, but they kept trying to claim, oh, there's trillions of dollars in savings. Well, they eventually had to admit that all that money had gone, which it is long since gone. And people were then relying increasingly, not just in the US, but the US is a good example, to pay for essentials with credit cards. Well, that's gone past the point of people now getting to the point they're defaulting at record levels. And I mean record levels. Forget 2008, forget 2000, etc. That they are defaulting because they can't even pay their credit cards anymore. Most certainly, savings rates have fallen off a cliff edge. We know credit card debt is well in excess now of $1 trillion. And, you know, consumer debt is now in the US over $17 trillion, as one example. And this, and obviously because of the big hike in asset prices, so things like housing is becoming unaffordable, or is extremely unaffordable. And so all these data points that are reality, that is what everyday people are having to deal with, you can't hide it anymore. And once you can't hide it anymore, then the illusion you're trying to pretend is reality has to give way. And we're now at that point. And that's going to make people very, very uncomfortable when they have to say, oh, well, all this fantastic economy we apparently have, and well, it's not true, and we're going to have to go back to QE, and we'll have to bail everything out and print trillions of dollars to prevent a collapse. And people then, will then go, what the hell's going on? Why has this happened? And confidence will evaporate very rapidly. And you can keep pumping equity markets as much as you want. It's it's an illusion. It doesn't matter if the Dow's at 100,000. Reality is consuming the illusion. And it was my point that the pandemic would be the trigger to set that chain reaction off, to the point eventually reality would consume the illusion. And I think there's reason to suspect we're at the cusp of that now, where it really will consume it.
I agree, very much agree. And before we move into Europe, last week we were talking about behind the scenes, some different topics to look at. And the one thing you noted of importance was, as we saw the dollar and the dollar index against the basket of currencies that are the primary ones start going down in the DXY, what was really significant was its relation to the Chinese yuan, the CNY. Well, take that and add in now where we're going to start dropping rates. Well, exports between the US and China have continued to escalate to newer and newer all-time highs every quarter. So the dollar's going to be, and we see today, just the announcement, we haven't even had the Fed cut, the rate cuts, but just the announcement that the policy switching to rate cuts likely in September, the dollar on the DXY is down to 100.70. It's probably over the next week or so going to fall below that. And of course, with the CNY is getting stronger. So this, of course, as more and more necessary exports come from China, because we're in recession, we're laying off people, we're not producing anything, it's going to be additionally inflation. So we're cutting rates, hoping that will create a little bit of disinflation, but it's really going to escalate inflation for people. And it's going to probably even push the recession deeper and deeper in, not getting out. This is the interesting thing that I found about the Fed, the fiscal policies that come from the US government, and the business cycle. Is business cycles normally had a 18-month period of getting out the bad debts and rebuilding themselves up for the next move higher, the next move of growth. But the more that the federal government did change fiscal policies, aka Glass-Steagall or whatever, NAFTA, etc., and the Fed started intervening after 1987 with Greenspan. We saw this in 2004. I'm sorry, 1994 under the Clinton administration, where it started creating the bubbles. This is really where the bubbles started coming on, the dot-com bubble, then following that with the housing bubble, and now it's the everything bubble. But every time we hit a recession, the more intervention that the Fed does, or the more fiscal policy changes that the government does, it makes it worse and worse and worse. And the outcomes really are exacerbated immensely. Lowering rates are not going to get the U.S. economy out of a recession very easily at all this time, like maybe it did by the shock of QE, because it had never been done in 2012. So now they're going to try to do this, and the fact that inflation is still well above the numbers that they need. If you're going to have the cost of imports, especially your primary trading partner, China, you're not going to get rid of inflation. You're not going to get out of the recession. Now, all of a sudden, you have solidified almost concretely stagflation. And we saw that lasted for more than a decade during the 1970s.
Yeah, I mean, yes, and okay, we're always back to the point: is history going to repeat itself? But there is indications that is a possibility. So therefore, it's absolutely worthy of mention, Ken. I think the thing that's interesting when I look at and what's going on at Jackson Hole, we're not going to get into the discussion because, frankly, this is my personal opinion. I'm not really interested anymore in what the Fed has to say, but the inference is rate cuts are coming. Now, unsurprisingly, gold rises. Silver, okay, rises more, no surprise there. The dollar index gets hit, well, no surprise there. But I think what's very telling is whenever we get an inclination of this, the dollar weakens significantly against the yuan and the yen. And therefore, can we extrapolate that if they keep slashing interest rates? What's that going to do? Because remember, there was all these people claiming that we were going to see the yuan devalue. Well, it looks like the reverse is going to happen. So I'd like to see how they explain their way out of that one. But also what we're seeing is the pound is rallying against the dollar. It's now up over 132. And everything points at why we would I don't think we would expect historically to see this level of weakness in the dollar on the basis of speculation. Okay, the speculation may be pretty solid, but for me, the dollar's been weak, and historically, I'd have expected the dollar index to be at 120, 125. It's never got near that. Yes, it briefly spiked, but it didn't stay there. And I think this is just indicative of the fact as well that de-dollarization does matter. People will say it doesn't, but it most certainly does. And of course, what's interesting on the back of this news is in dollar terms, the price of oil spikes. So higher oil prices is bad news for the United States, because even though everyone goes, it's the biggest exporter in the world, which is questionable, it's a net importer. So it has to buy a load of oil as well. And that's getting it increasingly more expensive, which is why the US has been trying to persuade OPEC Plus to ditch, this quota system, produce more oil and slash the price. And of course, that doesn't suit the Saudis. And by extension, Russia wants more, for a barrel of oil, because they happen to be fighting a war at the same time. So it will be interesting to see what happens when they actually get around to cutting interest rates. But, I think it's very telling about this currency move out of the dollar in the process now. And the other thing, of course, is historically, we've always found that, like the Bank of England and the European Central Bank, would never cut rates until the Fed cut rates, and they just went ahead and did it themselves first. We've not seen that either. I'm not saying that we should read necessarily too much into it, but it's a point of interest. And I think it's something we'll come back to from time to time. I don't want us to get bogged down every week necessarily in chewing over financial things, but when there's something worth discussing, and I think, when we both felt, Ken and I, that this was a good point to discuss this, that we do so, and that's why we've done this today.
Yeah, and I think as a final thought on this topic, the fact of the matter is as the Chinese yuan gets stronger, at least in perceptually, if not necessarily monetarily, but perceptually, just like central banks have been buying gold, the world has been dumping the dollar as their primary reserves. They no longer need it. And as the multipolar world starts to grow and continues to grow, and a lot of disconnects between the old Bretton Woods and the old Swiss system take place, more and more and more, and I think you made this point before we came on, more and more countries and central banks are purchasing Chinese yuan denominated bonds. So they're getting their reserves in the Chinese currency, ditching dollar treasuries and dollar based bonds. And then we're going to go ahead from there. The more that comes back, you're going to be dealing with the influx of inflation that the Fed has got to hoover up through its fake Euroclear, depositories in Ireland, the Caymans, or wherever they have them these days, to make sure that doesn't affect the general interest rates at the same time that the U.S. government has gone over the point of no return and having to borrow and deficit spend into oblivion because of how much interest they're paying, well over $1.2 trillion a year. So this cycle now has reached that pinnacle that no matter what happens, you're going to have higher inflation. You're going to have less economic growth. You're going to have a rejection of the dollar more and more. And what appears to be the two primary winners are gold and silver and the Chinese currency.
Yeah, just a couple of points about, you're right, the Chinese, ironically, the PBOC and Beijing are actually getting worried that the yields are dropping too low on Chinese government bonds. They may decide to intervene themselves to try weaken it. So that's how concerned they are. It sounds ridiculous, but it makes sense. And the other point, of course, is in a broader sense, there is the ongoing ditching of the US treasuries as a reserve asset, and nations all around the world are buying gold. And I've made this point before, but it's a good point just to mention, because there is the official gold market, and we've talked about the unofficial market and the opaque market. And all these people saying China stopped buying gold. And then finally, people are starting to realize, as one example of the opaque market, and this is obviously done due to sanctions, but what's happening is Russia sells its gold to China. So what China does is it dumps its treasuries to buy Russian gold, and it keeps buying Russian gold. There's no record of it for obvious reasons. So China continues to buy gold. It supports Russia in the process, and there's nothing the West can do about it. So again, just be very careful when you hear comments about this data and this data, official data, etc., because it's only a fraction of the reality of what's unfolding. And this is a good example where this benefits the Chinese. And the Chinese have been doing this for a long time, dumping US treasuries and buying gold, or dumping US treasury and buying yuan, etc. I mean, that depends whether they want to strengthen or weaken the yuan. They'll either buy dollars, which they have done in the past, and it is currency manipulation. Let's not pretend that they haven't been manipulating the currency. They don't want the yuan too strong. And therefore, when it got towards 6 against the dollar, went, this is too strong, and they took measures to weaken it. So just points, I think, worth making in that regard. So, yeah, I thought it was worth, because we seem to always pick on the United States. Well, I mean, it thinks it's the biggest economy in the world, which it isn't. But anyway, certainly what we're discovering across Europe is a very similar pattern. And Germany's a great example of this, where when you ditch getting cheap Russian energy, it's going to have consequences. We know huge amounts of deindustrialization is happening. But what you're also seeing, it's not just the fact of energy costs crippling companies across Europe and not just in Germany, but what you're also seeing, new orders are falling off. They're not the same as they were. We're seeing contraction in manufacturing output. Companies are cutting staff. Inventories are being slashed. And foreign demand from these companies is also in retreat. And it's not just affecting the manufacturing sector, but what we're now starting to see, if you look in the services sector, which is a big part of European economies, growth is slowing down. Basically, the bottom line is consumers are not spending anymore. They've slashed their spending. Why? Because they're either fearful of losing jobs, they've lost jobs. And this is something that's very, very prevalent, and something, of course, that isn't just a problem for Germany. It's a problem across Europe. France has the same problems. Italy, the UK is economically in serious trouble. Some countries less obvious than others, but this is why, Maloney is trying to make amends and mend bridges with the Chinese for that very reason. Because there's the need for Chinese investment. There's a need to try and stimulate the economy. Well, they can't do it themselves anymore. And, they've run out of road. And what they're going to do, slash interest rates, print trillions of euros to bail everything out. I mean, there's no way of fixing major structural problems brought about by long-term QE and low interest or zero interest rate policy, Europe particularly. And as soon as you exit, there is going to be consequences because your economy is completely dependent on endless cheap credit. Well, it's too expensive now. But fundamentally, also we are going through an industrial revolution, so to speak, and the West and the United States, including this, is they cannot compete with China. It's impossible. I mean, forget whether you're a big fan of renewable energy or not, but there was a target set in 2020 by Xi to produce annually 1,200 gigawatts of solar and wind energy. The target was to be met in 2030. They've met it today, or in the last week or so, 6 years early. Now, we can't even do things 6 years late in the West, so we cannot compete with them on this basis. And therefore, we're just going to have to accept that to try and compete with them, we're not going to go through the whole discussion again of having to get rid of financialisation, and we've discussed that previously. So if you're interested and you haven't already heard it, listen to that podcast. But it's just to reflect upon the fact that economic reality across the West is now getting to the point you can't deny it anymore. I mean, if your industrial production gets slashed and your exports are slashed, and also because the demand from foreign can be the rest of Europe, for example, it just becomes this self-fulfilling prophecy where generally business activity across Europe is contracting quite markedly. And, and they even have to admit that officially economies are in recession, meaning you have 2 quarters of negative growth, so to speak. Well, that's long been the case, given, again, all the data which is rigged and bears no relation to reality. But, when Germany starts to have serious problems, then, the rest of Europe is going to follow suit very rapidly. And when Germany craters, so does the rest of Europe. And that's why focusing on Germany is important. And, but again, it's this idea with financialisation that everyone just focuses, well, the DAX is at a record high and this financial data looks okay. Who cares what the real economic data is? And they're just not taking any notice of it because they've lived in a world where financialization is the only thing that matters. Well, because previously their policy decisions didn't have that bigger impact on reality, the real world, the real economy. Now it does. And they just do not have an answer to it. And almost their philosophy is, well, we went through this in 2008, so if the worst comes to the worst, we'll find a way out. We'll kick the can down the road and bail everything out. And what's the problem? Well, this time it's an everything problem. Previously, it was just, well, not exactly confined to the sort of commercial real estate sectors, but now it's an everything problem. And also because they've trashed and debased the currency so much during the pandemic. again, all these factors are stacking up, and reality is killing the illusion. And it's not just the United States, it's across Europe. And I mean, look at the UK, they've had a new government, and now they're starting to actually came out and went, we've got this big spending black hole and we can't keep spending it. It's tens of billions of pounds. So all the things that they promised not to do, they're now going, because that was the West's answer to everything is austerity. So let's slash winter fuel payments for elderly people, which is a disaster. I mean, okay, you can argue they shouldn't do it, but they have done it year after year for a long time. But these are policy decisions because reality is kicking in. And they, of course, have yet to have to face the reality that when things get so bad, what are they going to do? Are they just going to let everything collapse in totality, and the risks that that poses for many reasons across all spheres of the economy and the financial system and society? How do people react to that? We don't know. So therefore, what do? They're going to end up having to print like there's no tomorrow, like they did during the pandemic, because they were deeply fearful what might happen, how the masses might react, because there could have been the risk a lot of people lost their jobs, etc. So they did everything to try and mask that problem because they were frightened of how people would respond. Well, they're not going to suddenly not be frightened this time around. So, and if they have to go through QE again, they're going to have to slash interest rates, because the one thing, if you have endless QE, you have to have zero interest rate policy. Well, and what does that do for confidence in anything? I mean, basically, what that's telegraphing to the world is it's over. We clearly cannot manage our economy. We clearly, everything's completely spiraled out of control. And when the slightest problem hits, we don't have any viable economic financial policy to deal with it. Our answer will always be just debase the currency into oblivion even more than we've already done so.
Well said. Well, I think we could probably end this with the modern Marie Antoinette motto: monetary expansion for us, austerity for you.
Well, yeah.
Anyway, Paul.
It's absolutely true. I mean, and that's, well, it is and it isn't. We'll have to see, because given the gravity of what could happen, I mean, they didn't do that in the pandemic. They just gave everybody money in the hope that things wouldn't escalate out of control. But you think then they went into panic mode, and what they did, and just printed trillions and trillions to bail anything and everything out. Well, are we going to have the slightest problem again? So what do they do? I mean, can you imagine if overnight the Fed goes, we're going to have to slash interest rates from, say, 4.5% to zero? I mean, what does that telegraph to the world about the United States, about its economy, about its financial system, about the dollar? I mean, this idea of a safe haven, or not just slashing interest rates, but going, well, we're going to have to bail this out, plug holes here. We'll just have to print another, I don't know, 10, 20 trillion. Who knows what it will end up being? It's over. The world's not going to be forgiving this time again of that. And then it comes back to the question, given China bailed everything out last time, what's China going to do this time? I mean,
well, exactly.
And that's the $64 trillion question, never mind million or $1,000.
Yep. And the funny thing is the difference between the East and the West is, in China, if you are a minister and you have bad monetary or fiscal policy, heads roll. In the West, well, you have no repercussions for the actions of individuals who have no idea about finance or economics and destroy everything that they touch.
Well, the other point regarding this just is they would never, I mean, okay, there's corruption in China, and there has been. No one's, I mean, they've fired 1 million people from office in all, whether local government, central government. Yeah, corrupt. I mean, it's not anywhere near as bad, but there has been horrendous corruption in the back. But they generally don't tend to fire people for incompetence, because they don't put incompetent people in office in the first place. Whatever you think about the political system in China, the one-party state, absolutely true. But at least Xi was capable of governing. He proved himself by being able to manage 330, 350 million Chinese people, and did a successful job. And they went, well, you can now be the president of China itself, the entire country. We don't have people in those positions. We don't employ anybody in positions with the capability to do the job. And that's the big difference. And that's the thing, when all these problems and reality really consumes the illusion, who's going to be in position to deal with these problems? And that's the huge problem we face in the West.
Exactly. Anyway, Paul, I think that's a good place to
Yes,
stop
indeed.
it for the week. Big things coming on, and I know September is expected to be some fireworks when it comes to both the economy, global economy, the local economies, fiscal and monetary policies, but we shall have to see. We're not going to make any speculation, but we will be here to report it. Paul, I want to thank you as always for being a part of this great discussion.
Likewise.
And to everybody here, thank you for being a part of the community. Don't forget to like, subscribe, share this, comment, because we read the comments and they really help the algorithm. And we will see you on the next one.
Yeah, and I echo, obviously, Ken's sentiments. And with that, I'll also say goodbye.